Hey everyone, and welcome to your May 2025 Fraser Valley Real Estate Market Update. May is usually a powerhouse month for real estate, a time when spring buying hits its stride, with sales typically soaring well past the 1,600 sales mark in the Fraser Valley. But this year, as you might have gathered from the headlines, May was a different story altogether. We're seeing some fascinating and at times challenging trends happening. Let's dive into the numbers. In May 2025, we recorded just 1,057 residential sales across all property types in the Fraser Valley. To put that in perspective, that's nearly 38% below our 10-year average for May, a significant dip, indicating sustained lower activity. It's also about 21% fewer sales than we saw in May of last year. Now, on a positive note, we did see a 14% increase in sales month over month compared to April. While any increase is certainly welcome, it is worth remembering that a bump in sales from April to May is pretty typical seasonally. The real story remains that substantial gap from our historical norms. This continued underperformance tells us that buyer confidence is still very much constrained. So, what happens when the sales are slower than average? Well, you guessed it. Inventory starts to build. And May was definitely no exception. We saw 3,412 new listings come onto the market. This isn't just a slight increase, it's 16% more than the 10-year average for new listings in May. This influx, paired with slower sales, pushed our total available inventory higher. In fact, we finished May with 8,159 homes available for sale on the MLS in the Fraser Valley. That 8,159 figure represents a 6.5% increase month over month and a 40% jump year over year, at a remarkable 71% more homes available on the market today than the 10-year average for the month of May. This isn't just more inventory, it's a significant shift. Looking back to the Fraser Valley Real Estate Board statistics, we've only had more homes in the market for a brief 4-month period back in 2008 during the financial crisis. That's a stark reminder of the unique supply levels that we're currently experiencing in the market today. Now, let's connect supply and demand with the sales to active listing ratio. This metric tells us how many homes sell for every 100 listed. In May, only 13% of homes listed actually sold, putting us at the very low end of a balanced market. To reiterate once again, below 12% is considered a buyer's market, 12 to 20% is balanced, and above 20% is a seller's market. May's ratio was slightly up from April, but crucially, it was 10% lower than May of last year. Now, when we break this down by property type, the picture becomes even more clear. Detached homes remain firmly in a buyer's market, as they have been all year, with just an 11% ratio in May. Condos are teetering on the verge of a buyer's market at 13%, and townhomes, however, continue to be the most active segment at 17%. We've seen this trend for a while. Townhomes often appeal to both condo owners looking to upgrade and detached homeowners looking to downsize, creating a much broader pool of buyers than either of the other two categories. So, with this increased affordability, why aren't we seeing a stampede of buyers? Well, it seems despite our federal election being behind us and the noise around international tariffs somewhat quieting, there's still a significant undercurrent of uncertainty. Job security, the rising cost of living, beyond just mortgage payments, and persistent inflation are weighing heavily on the minds of many would-be buyers. Until these broader economic factors settle down and consumer confidence truly returns, we will likely continue to see this cautious approach to the market. Now, of course, with the high inventory and the slower sales, and being in a buyer's market, overall prices have continued to gradually decrease over the last 2.5 years. With just a slight 1% dip in May compared to April, we did see over 4% year-to-year decrease compared to last May. This steady, albeit low, price adjustment, combined with the recent decrease in interest rates, brings us to our next crucial point: affordability. If we look at the combined effect of price and interest rates, current overall affordability is actually quite comparable to March 2023, a period when prices were at their lowest point after the pandemic boom. Surprisingly, it also aligns with February 2022, which was just a few months before the peak of that intense pandemic housing frenzy. This means that, from a pure mortgage payment perspective, today's market offers a similar, or in some cases, better entry point than we've seen at various challenging moments in the last few years. For those of you considering a purchase right now, these market conditions, while not normal, could actually present a good opportunity. Affordability, as we've discussed, has improved steadily. Interest rates and prices have been trending down. The golden question, of course, is how much further will they go? Well, no one has a crystal ball, but what is certain are the conditions in front of us today: improved affordability and less frantic competition. Waiting indefinitely for a mythical perfect bottom could mean missing out on today's opportunities. Now, if you're a seller, your best course of action really does depend on your unique situation. While prices are generally expected to tick up again eventually, the when does remain a mystery. Many experts have predicted a stronger recovery earlier in the year, and those sellers who hold off hoping for significant price increases sometimes found themselves with a lower value today than if they'd acted a few months sooner. This isn't about rushing, it's about making an informed decision for your specific goals. Navigating a market with these kind of nuances makes working with an experienced realtor more crucial than ever. If you're thinking about making a move, whether buying or selling or both, I'd love to chat. Let's look at your unique circumstances and determine the best strategy for you. Thanks for watching, and I'll see you next month.